This week we'll be covering Chapter 9, and we'll be splitting Chapter 9 into 2 weeks. So this week we'll just be covering some of Chapter 9's content. And let's just review some of the problems, and we'll discuss some of the concepts as well that we're learning about in Chapter 9. Well, the first exercise, 9-1, is one of your Connect problems. And it asks us to calculate the lower of cost, what we paid for inventory items, and the net realizable value. So the net realizable value is our first calculation then, and it's the difference between our selling price and the cost to sell. So 40 minus 6 is 34. Once we have our net realizable value, then we're going to compare that to the cost. Take the lesser of the two. So we paid 25. Our net realizable value is 34. The lesser of the two is 25. And just repeat that process for products 2 and product 3. The next exercise asks us to calculate the cost of goods lost in the fire. So the cost of goods lost in the fire involves us estimating our cost of goods sold for the fire and the goods that were lost, and then we have to factor in, as we said, the recovery. So the first step I made in this calculation is I just determined the total inventory available to sell before the fire. So what did we have sitting in inventory before the fire? Well, we had 100,000 beginning plus the 150 purchases, so we had 250,000. Then I calculated the cost of goods before, I should say the cost of goods sold before the fire. So the cost of goods sold before the fire is determined by taking the sales and multiplying it by 1 minus 35%, or 65% of sales. So 65% of $220,000 is $143,000. All right, so that's the inventory we sold at cost before the fire. Cost of goods lost in the fire before considering the initial recovery. In this case, I took the total inventory available to sell before the fire. I deducted the cost of goods sold before the fire, and I wound up with $107,000. So before considering the estimated recovery of some retail items, the company lost $107,000 in inventory. When you factor in the recovery of $12,000, we're just going to reduce the 107 by 12,000, and that's our net cost of goods lost in the fire. And using my numbers, my adjusted altered numbers, it's 95,000. So that's the estimate of the cost of goods lost, in this case in a fire, using the cost of goods sold approach, which can be used, as I said, for budgeting, for interim reporting. It can be used for determination of a catastrophe loss, like a fire, and so forth. Another method of estimating inventory is using with these retail methods. We're just going to focus on the retail method that involves the average cost and the conventional retail. So both are retail methods of estimating cost of goods sold and any inventory. That's the objective. And they're both retail methods, so we're going to really isolate the relationship between the cost of our inventory and what we sell it for, the retail. We're going to use that relationship then to estimate our ending inventory and our estimated cost of goods sold. And there I'll talk a little bit about the differences between these two. All right, so in the first case, this is the average cost retail method. So the way to do this is just to lay the data side by side. We have the cost data and we have the retail data. We want to calculate the cost to retail percentage so that we can apply it later to determine our cost of inventory and our cost of goods sold. All right, so let's take a look at this. On the cost side, beginning inventory cost us, using my altered data, $36,000. We sell it for $50,000. So we'll just enter the given data. Net purchases, $19,120 on the cost side. The retail side is $31,600. Markups, that is only a retail calculation, right? Because that's what we sell it to our customer. We're marking up what we sell it to our customer. So that'll be only on the retail side, $1,200. Net markdowns, again, that's a reduction of the markup. And in this case, it's going to be a negative $800, but again, only on the retail, since that only affects the price. So now we have the goods available for sale at the cost basis and the retail basis, just by adding these items up. So on the cost side, we have 55,120 of goods available to sell, and the retail side is 82,000. So divide one into the other. 55,120 divided by 82,000 gives us 67.22%. Now, after we determine our cost to retail percentage, we'll take out on the retail side our sales. So we sold $32,000 worth of our inventory. That was given. Then we can determine our estimated ending inventory at retail. That'll be the 82,000 minus 32,000. So this is our ending inventory at retail, but we want to know what our ending inventory at cost is. And that gets to our final answers in this question. So I'm going to take the 50,000 ending inventory at retail, multiply it by our cost to retail ratio, and that'll give me 33,610 ending inventory on the cost basis. And then finally, our estimated cost of goods sold. I'm going to add together the goods available for sale at cost, and then I'm going to take out the ending inventory, since that's still sitting there unsold at cost. And that'll give me the estimated cost of goods sold of $21,510 using my numbers. The conventional method is a little different, but not much. The overall approach is the same. In this case, however, we're going to take the markdowns, and we are not going to include the markdowns in our ratio. So they're going to be brought down further on our list, and they will be excluded from the calculation of the cost to retail percentage. So again, enter the information that's given, and I've altered some of the data again. Purchases, we have freight in. Freight in is only a cost that listed on the cost side only, not on the retail. Markups, that is a pricing issue, so that affects only our customers. It's on the retail side. And just add the items together again. And you'll notice that we are not including markdowns in our ratio. So we take the 803,000 total goods available at cost and divide it into 1.15 million goods available for sale at retail, and then we have 69.83, or roughly 70%. Now we can just continue like we did before. Now we're going to bring in those markdowns on the retail side. So we'll take out the markdowns of the price and then continue as before. We have goods available for sale. Now we're going to include the markdowns and then deduct your sales on the retail side. And then, of course, the 1.146 less the 800,000 gives us 346,000 estimated ending inventory at retail. But again, the problem asks us to calculate the estimated ending inventory at cost. So in this case, I'm going to take the 346,000 times 69.83%, or 70%, and that will give me the estimated ending inventory at cost of 241,598. So very similar to the average retail method, with the exception of the markdowns being moved down. Next week we'll talk more about the LIFO method, because of course there adds a complexity to the calculations. And I can reintroduce this, what you see on the screen here. I've modified it slightly to create some different calculations. But at this point, I would recommend this week just reviewing the LIFO retail method. And then next week we'll go into this in greater detail. I'll leave these two on the screen so you can stop it and make a copy of it. And then next week we will cover this in greater detail. Because it is a little more complex, here we're going to have to deal with, in some cases, multiple cost to retail percentages because of the layering issue. And then finally, exercise 916 was not assigned, but I just wanted to mention as part of this week's coverage, calculate the cost to retail, laying these side by side, entering the data. We already went through the approach to use, purchases. Freight in, we talked about, that's added into only the cost side. We didn't mention purchases returns. So purchases returns has both a cost effect and a retail effect, because what are we returning? We're returning the purchase, part of the purchases. And purchases, of course, has a cost and retail effect. So in this case, we are going to return some of what we purchased, Therefore, it's going to have implications for the cost side and the retail side calculations. That was one thing I wanted to mention. The other thing I wanted to mention was spoilage, normal spoilage. And normal spoilage would be considered on the retail side because it's really a loss of our profits. And it comes after the cost to retail percentage calculation. Note that because we have the net markdowns listed below, this is the conventional method again. So this is the conventional method, but we've added a few other items to the costing of these calculations. And one we've added is the returns, and then the other one, which is included in the cost to retail ratio, and then the other one we added is the spoilage, normal spoilage, which is considered after the ratio. It's still factored in our calculations on the retail side, but it is not used in determining the cost to retail percentage. So if you have any questions on any of these methods of estimating ending inventory at cost and cost of goods sold, which is the primary objective of this week's assignments, using various methods, please let me know.